Welcome everyone, and thanks for joining us today to the Buligo and CBRE seminar. We are excited to present this session in partnership with CBRE, a global leader in commercial real estate services and investment. We work with CBRE often on acquisitions, financing, disposition of properties, as well as property management and leasing. We have with us today K.O. Kennedy, a personal friend and vice chairman of debt and structured finance in CBRE's Nashville office. If you need real estate debt, K.O. is your guy. We also have with us as speakers today, Matt Vance, vice president and America's head of multifamily research and senior economist with CBRE Econometric Advisors. Matt's insight and is regularly featured in leading media outlets and help guide wide range of client strategies. We also have with us Darin Mellot, vice president and head of U.S. capital markets research. Darin leads the CBRE global research team and his frequent advice to policymakers, and is recognized for his thought leadership in both real estate and broader economy. We'll start with a brief introduction to Buligo Capital, for those of you who don't know us. So I'm Goren, founder and CEO of Buligo Capital. I have with me Zror, VP of Business Development at Buligo. And Buligo is really a real estate investment firm. We are a publicly traded company, specializes in U.S. real estate, in 4 core sectors: multifamily, industrial, senior housing, and grocery anchored shopping centers. And we have a great pipeline and very good track record that you can see here on the side. So to date, we've invested over $4.8 billion in 160 properties, so long-term and successful investment experience. We have sold over 70 properties, over $2 billion of realized value, and we return to our investors over 24% IRR and over 2.1x in equity multiple on their investments. We have a very strong hands-on approach in those sectors that I mentioned before that we are investing in. And now we'll turn into Matt to start the session of CBRE.
Thank you so much for having us. I'm just going to share my screen here, and we've titled this the U.S. Commercial Real Estate Outlook. Obviously, we're going to tailor our comments to Buligo's focus in their sectors, but why don't we start, Darin, with an overview of what's happening in the U.S. with policy and CBRE's house view, as much of that drives our outlook.
Yeah, Matt, I think it's quite interesting, the time that we find ourselves in, because many of the economic outcomes in our forecasts are more dependent on policy outcomes than we would traditionally say, right? I think everybody's very familiar with the administration's shift in trade policies and the tariffs and various ongoing negotiations and things there. But focus is also shifting toward the passage of this massive tax bill that's making its way through Congress right now. The House has passed it, and it's moving into the Senate. And I think there are a couple of things to say about both of these large policy initiatives. With regard to tariffs, our base case it assumes that we're going to continue to see more deals getting done. And I think, for the benefit of the audience, when we talk to various investors, both US-based and non-US based, right now investors are looking through the tariffs issue. And Matt, you and I were at a conference recently, and it was interesting because I had prepared a whole bunch of remarks on tariffs, thinking that this is going to be what people were most concerned about or interested in. And so we polled the audience, which had several hundred of our clients, and that came in dead last. And frankly, in all of the meetings that I've been in over the last several weeks with investors large and small, I think investors have generally said, what, look, there's a lot of noise. It's creating some uncertainty, yes. But we think, base case, they agree with our base case that, these things are going to get resolved. The uncertainty is going to lift as we move through the summer. So, tariffs aren't as big of a deal as certainly they could have been. I would say, just following April 2nd, we were looking at a shock much larger than what we see now. But that situation seems to be relatively contained. Now, with regard to the tax bill, I think this is going to have an interesting effect because what we've seen over the last 6 months or so is what we refer to as the soft data, the sentiment data. Matt, you know as well as anybody, the consumers and even to some extent businesses have said, we don't like the uncertainty, we don't feel good about it. But then when you look at the hard data, it's actually come out, quite strong. I think what we, can take from that is the U.S. economy always surprises with its resilience, and that's certainly true today. We could see some of the impacts of that uncertainty filter in the next quarter or so. But with the passage of that tax bill, I think you're going to see that sentiment turn around, and I think you're going to see that hard data actually begin to firm up and even improve as we head into 2026. So those are the two big policy things that we're taking a look at. Obviously, a lot of things are going to be shaped in the Senate, but that leads us into our House view. And so what is the impact of all of this going to be? Well, let's start with GDP. So this is, you can see a 0.6% there. That's going to be revised upward. We're going to be releasing a new House view in the coming days here. And what we think we're going to see is we're probably going to see growth averaging somewhere just under 2%, somewhere in the kind of high 1% range for 2025. So, there is some impact on uncertainty from the uncertainty, but we think that as things have, tensions have lessened and the tax bill gets passed, that we're actually going to be much better off than what we had anticipated even just a few weeks ago. And so, what does this mean in terms of inflation? Again, lower tariffs mean inflation is not going to be reaching quite as high as we had anticipated. And so I think you're going to see inflation much closer to the Fed's target, kind of in that, call it mid to high 2% range is where I think the macro forecast is going to end up. And so you say, okay, well, we've got slower growth, not as high inflation. What are the implications for the Fed? What are the implications for monetary policy? And we are currently expecting 2 cuts, but we don't expect them anytime soon. We think it's going to come late in the year, probably October at the earliest, because the Fed's not going to want to be cutting as the impacts of the tariffs are sort of filtering through into the data. But an important thing is that the Fed, and one of the reasons why they're not going to cut as soon is because they want to keep inflation expectations well anchored. And so, and we think they will. We think, look, most businesses, most folks that we talk to are looking through this and saying, look, we don't think this inflation is going to be a shock. We think it's a price adjustment, and we don't think it's going to be quite ongoing there. But on the long end of the curve, which perhaps matters the most out of any of this for real estate investment, we think it's going to remain in a range that's going to allow this continued recovery in investment volumes to move throughout the year. So, we have the 10-year kind of averaging in the lower 4% range. We think we're going to be range bound between that 4 and 4.5% range in the 10-year yield. Now, one of the things to look at, you can look at this and say, well, okay, this is a bit softer than what we'd anticipated. But I do think that it's important to note that even with this revision to our forecast, which we revised down, and now we're revising back up based off of some of those developments in policy, the U.S. remains one of the strongest economies, fastest growing economies in the OECD. And so, this is one of these things you may have heard. The term, the cleanest dirty shirt. All of economies are sort of working through some messy situations right now. But in terms of the U.S., it's proven to be quite resilient, and I think we're expecting the U.S. growth to continue to outpace many, in fact, most developed economies throughout the world. And so that sort of brings us into the capital markets side of things, Matt, or actually let's talk about some of the scenarios.
Well, yeah, I guess you touched on range-bound interest rates. We also think about the overall broader economy being a bit range-bound, right? We forecast it, like most shops, with various scenarios. And so here what you have is really working left to right, our baseline forecast. And as Darin said, this is our thinking as recently as just a few weeks ago. And so as we reforecast things monthly, as we're doing now in June, to Darin's point, just a few weeks ago, we didn't think that there was much upside potential in the economy, which is that middle chart there, which doesn't look very different from that chart, that baseline chart on the left. And we felt like there was considerable downside risk of a policy error from this administration in the US. And so as we think about this range of potential outcomes, we do expect more upside potential today than we did back in just May of this year. And as we put probabilities around these different scenarios, like Darin said, we were presenting our outlook just even a few weeks ago. And we would have said there is significant likelihood of a downside stagflation type scenario, where today we've really reduced that likelihood and shifted much more of that probability into the baseline outlook that's being revised, and even some additional upside, I think, Darin. So those shifts are good for us in real estate. That is, the hard data continues to come in strong, as you said. And as we think about the consumer, right, we hear headlines about delinquency rates being up and sentiment being down. We've looked at the data, and none of it is overly alarming, particularly as we think about getting through this next 6 months or 12 months, and we see this economy start to grow at a more meaningful pace.
Matt,
So,
I think you bring up a really good point there. The reality is, with these various scenarios, we see an environment that is generally supportive of commercial real estate, right? Whether it's long-term yields remaining at levels that are going to support a continued recovery and investment. When we look at GDP growth and where we see the labor market headed and things of that sort, I think this is one of the interesting things about real estate right now is we're sort of heading into, we've had this value reset because of changes in interest rates over the last several years, but the reality is the fundamentals have remained extremely strong. And so I mentioned this because later on we're going to talk about kind of this moment in time and why it's unique. And this is an important thing to bear in mind, that all of these conditions are supportive of not just continued investment, but of fundamentals themselves.
very good point. So now let's get into the real estate. Let's get into the meat of this discussion here with the capital markets first, and then we'll transition into fundamentals. But KO, Darin, why don't you start with this chart? What is it, and what does it mean?
Yeah, and I'd love to have KO jump in here. I mean, look, we have a lending index, and so we are obviously looking at debt market conditions here, and you can see the improvement in recent months. You can see some of the impact of some of the uncertainty and whatnot, but we've seen things continuing to improve after that sort of Liberation Day shock, shall we call it. And in fact, it was kind of, I feel silly even calling it a shock, because it was one of those things where you kind of blink and you miss it. I think there were people questioning for a matter of a few days what was going on. I think within a week, the debt markets were up and running, and we're starting to see spreads compressing. And the other thing that I would point out to folks is that, we didn't have everybody, all of the different players as active in the market throughout 2024. But at the end of 24, we actually saw the banks starting to get back into the market. And so, there were all of these ominous headlines about, real estate exposure in the banking sector and things. We thought it was exaggerated from the beginning, although there were some real issues and that needed to be cleaned up on balance sheets and things. And the banks did that. And they are back into the game, and frankly, some of them are quite, getting quite competitive. And so I think what this chart tells me is liquidity is not going to be an issue. this is one of the reasons why we expect that recovery in investment volumes to continue. Ko, I don't know if you want to jump in with any kind of real-time insights and things that you're seeing in the market in terms of continued spread compression, et cetera.
Yeah, thanks, Darin. Yeah, we're definitely seeing spreads compress. And to your point about liquidity coming back in the market, in particular, we've seen banks come back in a big way over the last probably 60 to 90 days. And it's been pretty remarkable to see. The spigot was all the way off until probably 2 or 3 months ago. And now, banks are starting to do 60 to 65% loan to cost construction loans on multifamily in certain markets now. And on the long-term debt side of it, we're seeing most of our clients still pick the 5-year term, mostly fixed rate Freddie and Fannie loans for multifamily, because I think they're all sort of betting on treasury yields to keep going down over the next 3 to 5 years, and they want another bite at that apple in 3 to 5 years. So, but also I do want to mention too. The equity markets have really provided a lot more liquidity for new construction recently too. Much in the same way as banks were just sort of out of the market for really 18 to 24 months. About 60 days ago, we started getting a lot of calls from big equity shops that are not just interested in Nashville, but just in the around the country overall. Putting out some capital for new construction product. So it's been fun to see. I think that this trend is going to continue. Frankly, we had the second largest year we ever had in our office last year, and we're on pace to beat that this year. So I feel very, very bullish about the direction that we're heading.
Ko, you bring up a really good point about the agencies. For the folks on the call, right, in the U.S., we have the lending agencies, Freddie Mac and Fannie Mae, as well as FHA and HUD, who provide a unique amount of liquidity to the multifamily market specifically, where we're seeing the tightest spreads. Yuri, we were talking, in preparation of this. You have a similar experience, yeah?
Yeah, exactly. So we also in our multifamily segment, so we use Fannie and Freddie, as you guys know, and 18 months ago, interest rates were around 6.5%. In recent transactions that we did, recent refinances, it's 5.5%. We also, by the way, Ko, to your point, we prefer a longer term debt. So we usually use 7 years, just to be on the safe side. We are not sure exactly what's going to happen and when, and we prefer to limit our downside. But yeah, to your point, it's exactly what we've been experiencing.
Yeah, we've definitely seen spreads go down in multifamily through Freddie and Fannie, but also with bank and insurance companies. You see spreads are down, and all-in interest rate is down probably at 1% or 1.5% in some cases from a year or 18 months ago.
I feel like that Matt and Darin, you guys, I think, are predicting that the 10-year Treasury is going to end the year around 4%. If that happens, that'll be it's currently 4.43 right now, but that's going to have a substantially positive effect on transaction volume for 2026 and going forward. Right now, there's a sort of a gap in the buy-sell expectations, and it's I think there were probably 9 transactions in Nashville last night or last year. But like in certain markets like Indianapolis, gosh, I think they saw 30 to 40 transactions last year. And so it's going to be, but I think overall, once you see that 10-year drop to around 4%, that is where I think most clients are going to start doing longer term debt deals, and B, I think you're going to start seeing a hell of a lot of transactions, especially in these hot southern markets.
Yeah.
Ko, it's like we rehearsed this with you, Darin.
Yeah, it was a perfect segue, really. Look, I think as I mentioned, we think it's going to be range bound, but yeah, we think we're going to end up in that lower 4% range. But something to note: the 10-year Treasury. Look, the Treasury Secretary has been very busy with the trade deals and the tax bill and things of that sort. But Treasury Secretary Bessent has been very adamant that the administration is laser focused on getting the 10-year yield down. And that's you're probably going to have to, there's going to have to be some fiscal adjustment for that and different things. But the Treasury also has a lot of different tools. And so that's one thing that I'm keeping an eye on as a potential upside, is as the attention sort of focuses away from those large pieces of legislation, that we might see the administration starting to focus in on that. And to your point, we're with you 100%. We think there's a lot of upside with regard to transactions. So we basically have treasuries under 4.5%, strong fundamentals, lots of liquidity in the market, and this is where we think it ends up taking us. We think we're going to be up by about 8% this year. I think important to note where a lot of these volumes are going to be. It's where Matt. It's in Matt's playground is what I call it. It's multifamily continues to be the most preferred property type, is quite by a significant margin, followed by industrial. But one of the other things that I would say is, Matt, go ahead. Why don't you address this multifamily, and then on the cap rates, I'll come back and I'll talk about some of these other property types.
I love it. Yeah, to your point, when you look at apartment or multifamily investment over the past 20 years, it has emerged as this dominant force within commercial real estate in the U.S. And when you add the growth and emphasis that's also been put on industrial and warehousing space, together they account for almost 2/3 of every investment in the U.S. And we'll talk about those cap rates next. But Yuri, we heard you say initially that you're invested across almost all of these sectors, maybe with the exception of hotel. Does it mirror this, what we're seeing here, sort of broadly market wide?
Yeah, definitely. We see, if we had this chart on the transactions that we've been doing, so definitely we've seen growth in industrial, many more transactions, multifamily, very, very active. I think actually I'm just looking at it now, but the green section is telling the story of office very interestingly, how it went down and from 15 years ago to where it is now. So yeah, great chart.
But there is still investment in office, and we're going to talk about why, right? It is a prime time to be in that sector. All right.
We're actually looking at opportunities in office because offices suffered post-COVID so much. It's in a deep crisis. That's why we see so little investment in office compared to 2 years ago. And we see this as a potential opportunity, but very selectively.
Many of our clients share that sentiment for the right buildings in the right neighborhoods, locations, and at the right price. So Darin, as we talk about the ramp up in activity in industrial and multifamily, and we look at historically just how much, in particular, industrial cap rates have compressed as a result of that increased investor focus. What's really what is our outlook for cap rates, and what's underpinning that?
Well, look, I mean, obviously in industrial, there was a structural change in terms of demand led by e-commerce, right? And so we've seen industrial completely, the demand profile completely change is what I would say. But look, when I am looking at this chart, what this tells me is a couple of things. Number one, cap rates have peaked, and why is that important? We've done a bit of research on this. I've actually put out a couple of pieces recently on 2025 as an investment vintage. And what we see is, historically within, the next 4 quarters after cap rates peak, which we kind of placed that peak at the end of last year, that's when the highest returns for the cycle are achieved. And so, when we go to various client meetings and different things, yes, there's a lot of volatility, there's uncertainty here and there, but why are they so committed to the market and willing to look through? Why are values holding so stable, even as the 10-year has been as volatile as it is? There are a couple of reasons. One is there's been a scarcity premium, right? And so, there's not as much product on the market. But then the other thing is people are saying, well, look, we want to scoop up what is on the market because we've seen this value reset. And we know that the highest returns are going to be achieved now. The second thing that I would point out on this chart is just that we expect cap rates to compress more slowly this cycle than in the past cycles. And the reason why is because we simply don't expect interest rates to return back to the levels they were, certainly during COVID and prior to COVID. We don't see a return to those super low interest rate times. And so the cap rates are going to compress much more slowly. But I think, Matt, the next chart that we're going to show,
but they're going to compress. That's maybe,
but they are going to compress. That's right.
Yeah.
I think this year we're probably going to see cap rates staying largely flat over the next few months, but we're certainly going to see that compression appearing in segments of the market by year end. And I think 2026 we kind of see that continued gradual compression. Yeah, that's right. But one of the things I was going to say is, before you had this sort of, rising tide that was fueled by low interest rates, pushing a lot of capital into real estate to try and achieve higher yields. Because we don't see that happening, one of the points that we make with clients is that you have to really mind your due diligence and work with experienced folks like Boligo, because a lot of the returns in this cycle are going to be disproportionately driven by income, by NOI, right? Because we don't see that sort of low interest rates just continuing to boost asset values. It's the NOI. And so you really want to be smart about where you're at. Due diligence, always important. But I think there's going to be some folks that are differentiated in this cycle, depending on how well they understand that.
Yuri, any additional commentary on sort of market timing here, based on maybe in response to what Darin has had to say just now, before we get into exactly where he's left us off in terms of really leaning into that income returns component of the investment strategy?
Right. So yeah, definitely, we've been saying it again, looking also at your materials over the past few months and sharing this exact slide in our capital markets presentation to investors.
Right.
So it feels like, if you try and look at the previous recession, so 2009, 2008, and see how it happened back then and what we're seeing right now, it seems like this time, maybe the past 12 months and maybe the next 12 months are the best times to invest, right when you are in this kind of like distressed situation. Investors are cautious, they are a bit more concerned. And this is exactly what you see here, that, returns have been low. But if we're looking at the Great Recession back in 2008 and how it played out, it will probably play out the same this time. And starting in 2026, we're going to see the higher returns. I would also mention to what you're saying is that we are focusing on trying to project and base our investment thesis on NOI growth rather than cap rate compression, and industrial in specifics, trying to buy assets where we see that leasing that rents are below market, and we have the opportunity to market investments in multifamily, focusing on growth areas where we think rent is going to increase, and we'll see the significant increase in NOI. So yeah,
I'll just add to it that here you see the trend in multifamily total return. You see the negative return in the 08 recession and the negative return in the last 2 years. If you go back one slide to your previous slide, we can see the same for the cap rates. So cap rate expansions through the 2008 Great Recession, and again, cap rate expansion through the last 2 years. So really, real estate is kind of in a crisis mode. But there is a huge difference that we must remember between those two recessions, right? The Great Recession started from real estate, and there were so much oversupply, right? You remember they built everywhere. You had single family homes empty, the subprimes, multifamily project for nothing and empty. So the real estate market, the fundamentals were completely off. But this time around, it's not the case. The real estate crisis is due to the inflation and interest rate and cap rates, but not the market is not out of balance. There is balance. There may be pockets of oversupply, but very, very little. Everything is absorbing, and the market is actually in a great place.
I want everyone to know that these seamless transitions were not actually planned, because Itay, you're exactly right, and it is exactly where I wanted to take this next few minutes, and that is to focus a little on multifamily. I think multifamily is hugely important to retail and industrial. They follow rooftops and migration trends, and exactly to your point, where are those growth markets on a longer term basis? But what's happening today first? All right. So on this first slide, and to your point, the markets are balanced. All right. The occupancy rate for multifamily has recovered to its equilibrium. It's actually more than improved beyond the occupancy rate that we saw going into COVID and the pandemic. That is nationally. All right. And so this is the effective rent growth outlook that we have at CBRE. And you can see it looks similar to that GDP forecast that we saw earlier, where things recover. They take a little pause during a period of just a little bit slower economic activity and growth before they resume that recovery and get into the 3.5-ish% year-over-year rent growth period. So let me give you, I think, 2 points that I'd like to make on this chart. Number one, the 5-year outlook nationally is for 2.8% annual rent growth. That's for multifamily. And for context, that's slightly better than the historical average, better than the years leading into the pandemic, which were 2.5%, maybe 2.7%. The second point I want to make here is that although the very near term, all right, in markets like Phoenix and Denver and Austin, Texas, where rent growth is still negative, and it's pulling this average down, not quite negative nationally, but in those markets, rent growth is negative. Despite that near-term supply challenge that Itay just commented on, the outlook for a market like Phoenix, from our perspective, is almost identical to the 5-year average rent growth that I just said we're expecting nationally. So 2.7, 2.6-ish% 5-year average rent growth, even in a high supply market like a Denver or a Phoenix. And that is because of what Itay said, and the focus on and the impact of these markets being long-term growth markets for the country. Economic engines across the Sun Belt, in markets like Nashville, where KO sits, and others really across that Sun Belt and the Mountain States, Salt Lake City, where Darin is today, I believe. And so what does that, how do we get there? All right. And this is a complicated chart. We're going to share these slides with you as a follow-up, but I just want to take a moment to look at those markets that have the most supply, many of them in the Southeast, many of them in the Mountain States. And there's one takeaway from this chart that I want to make or give you. And that is that with only a few exceptions at the top of this list, we expect all of these markets to achieve some positive rent growth this year, despite the amount of supply that's still in the market. And that's because of just how strong renter demand is in multifamily. And even in a market like Denver and Salt Lake and Austin, we expect that rent growth to turn positive. And really, once we get through that supply wave next year, start to hit an outpacing rent growth period in 2027 and 28, which gives that 5-year outlook a really strong lift. Yuri, how does this reconcile or marry to your outlook and your underwriting?
So yeah, definitely. Also, the previous chart chart and this one, like you said, so we have seen this decline in rent growth, mainly because of oversupply. I think that and people were obviously affected by the high inflation. It is stabilizing. We are actually projecting a bit higher rent growth in 2026, 2027, even getting to 4%, mainly because we're in growth markets. So the southeast, where we see strong immigration patterns and people are moving to those areas. A lot of factories are being built and industry that is coming to those states. But yeah, overall, this is what we have been experiencing in multifamily.
You bring up a really good point that most, I would say, of our clients underwrite stronger rent growth than our modeling produces. All right. I just got done saying 2.8% over 5 years. Most successful bids and buyers today are underwriting 3% or 3.2 or more average 5-year rent growth. And I get asked, how do I reconcile that in my investment committee when you're projecting just 2.8? I know we're not far off, but we do have a different outlook. And what I want to say is that these forecasts are for new leases. All right. These are not rent growth projections for renewals, which today in our market, we know that renewals are elevated. Uncertainty around the economy and for other reasons, renewal rent growth is in some cases much stronger than what we're seeing in the new leases from properties that are delivering and trying to lease up. And when you blend almost 50-50 renewals and new leases, it's not difficult to get. It's actually pretty conservative to get to a 3 or 3.2% outlook. So Yuri, I totally agree that if you take a blended approach and you underwrite a building as you should, right, what your turnover rate's going to be each year and what your renewal rates are going to be, it's not very hard to get to that stronger sort of overall rent growth.
Yeah, that's I'll just add to that just to explain a bit, but when you right in those years that you show in the past, 12 to 18 months when it was harder to increase rents, so you are right, tenants that were in the buildings, we wanted them to stay, we didn't increase rents, and now we're making this increase. So yeah, you see more than the 2.8%. So yeah.
Matt, before you turn to senior housing, we have a couple of questions from an investor, if you will. One is, what is the effect of the projected deficit? How is it going to affect the 10-year rates? So deficit effect on the treasuries. And the other question is regarding tariffs, and specifically tariffs on aluminum and iron, potentially 25%, and 20 to 30% on China. How do you expect these tariffs to affect construction cost?
A couple of different things. I'll just start with the 10-year, Matt, if that's okay. Look, our forecast takes into consideration the large deficits. If we weren't running these large deficits, if the tax bill wasn't moving through Congress right now, we would see a lower 10-year treasury. And so my answer is that our forecast factors those things in, and the net effect of it is, look, if deficits were lower, the 10-year treasury would be lower. But even still, we think that this is an environment where deals can get done, where folks can deploy capital. And look, there's going to have to be some sort of fiscal adjustment over the medium term in the U.S. There's no question about that, and I think even folks in the administration talk about that as well. And there are some efforts underway. And I think there are going to continue to be efforts underway. So we don't see anything, a material risk of, unexpected sustained spikes in the 10-year at this time. We think the market has actually priced these things in right now. And so again, this is what informs our base case. In terms of construction costs, I mean, this is a little bit of a moving target with the tariffs because there are negotiations ongoing, right? And so I think the important thing to keep in mind, and Matt, in fact, you and I presented at the conference right after April 2nd, right? And the point that I made to our clients then is, look, the policy that we're dealing with today is not the policy we're going to be dealing with in perhaps 2 weeks, certainly not in 2 months. And so this is going to be evolving. Right now, as I've talked to folks, we think this is probably going to it could put upward pressure in the range of 3 to 5% in terms of construction costs on a multifamily project, for example, less so for other property types that don't have the same types of materials and finishes and things of that sort. And so what I would say is, in short, to answer your questions, 10-year Treasury forecast takes deficits into consideration. And number two, we do think there is some upward price pressure on multifamily construction. But from the folks that I talk to, they think they can manage through it fairly effectively right now. And again, just keep in mind the policies of today won't be the policies of the next quarter or two, or certainly what we're going to be dealing with for the next several years.
Thank you.
Matt, I don't know if you have any other points that you would want to add to that.
Thanks.
Really, no, great answers. And it really just tying it back to KO's earlier comments on not just the debt and the favorable terms on construction lending, but also the amount of large equity that is interested in development, despite this outlook that they all share that construction costs will be receive some upward pressure from these tariffs. They view this market as an opportunity, as there's not a lot of new projects being started, and if you can make it work financially, you're going to be delivering something in 2027-ish when very little else is coming out of the ground, and you'll be the newest and the best product as the economy's kind of hitting its stride. If you think about our outlook and job growth and job security and sentiment coming back, it'd be a great time to be delivering something. Yeah. And it's what we're hearing. It's what KO just commented on. Anything else? Any other questions, by the way? We've only got a few minutes left.
Let's continue, but people are we're happy to answer questions. And if you do have questions, please write to us on the chat.
Yes, please. Look, I've only got 2 slides on senior housing, like I did for multi. The first here is cap rates across various subsectors of senior housing. And much like the other sectors we saw earlier, we do think that cap rates have peaked and have stabilized. This is data that is not yet released. This will be with our senior housing investor survey that comes out this week. But it gives some insight. But behind this, right, were some questions that we asked our senior housing investor and developer clients. Why, right? Why do you believe cap rates have stabilized? And it comes back to that transition we just had from the capital markets into the strong fundamentals, because the same story is true here. And it's really true across most of the housing sectors in the U.S. But for senior housing, all right, it is investors and developers really leaning into the idea that we're going to continue to see really healthy rent growth. And CBRE's perspective is that we'll see above 5% rent growth over the next 3 years. And others share a very similar perspective, ranging from 3% to 7% over that period.
That's also our experience. I mean, we are seeing tremendous rent growth in this sector in the Southeast, mostly around Atlanta, Georgia. And we also see lower cap rates. So I guess what you're showing here is national, and maybe there's more people want to buy more in the South. But we see probably 1% less, give or take, in cap rate for every subsector.
And you're exactly right.
Sorry, and our properties are new compared to older.
That's right.
Properties.
Newer properties that have stronger demand, tenant demand, and particularly in Southeast markets is where we see stronger fundamentals, stronger rent growth, which of course drive lower average cap rates. So that perfectly aligns with our experience. And so we have forecasts related to senior housing. We expect that we will need almost 150,000 new units in this country through the end of 2027. And when we started this year, just over 20,000 were under construction with very few new starts. And so this imbalance of supply and demand is really what underpins our outlook for strong rent growth. And then geographically, our outlook aligns with your experience, Ite, is that, when we look at the population growth of the 75-plus-year-old cohort broken out here by these regions, you can see just the outperformance on the demand side of stronger population growth, particularly in the Southeast and in those Western markets. And so this is what we think will drive a continued outperformance and lower average cap rates and likely higher returns in these Southeast and Western regions when it comes to.
And I'll add that although the high demand, it's hard to build. It's hard to develop senior homes today. Many lenders are not lending to this space. And now with increased cost of construction and in higher interest rates, it's really hard to develop. If you're not experienced developer, it would be even harder to get lending. So we've developed throughout COVID. We are developing today as well. So I think that's imbalance between demand and supply is going to be with us in at least in the next 7 to 10 years.
Yeah,
we have a question. It might be a good time to speak about it. So what about growth and markets in the Midwest and the mountain states? Maybe you can also relate to multifamily, because we touched those less, I would say.
Well, look, for multifamily right now, the top performing markets are the Midwest, the Northeast, and the large coastal markets like DC, New York, and Boston. Chicago is a top performer. Seattle is doing very well. And the Sun Belt is underperforming today. But as we think about longer term projections, all right, we expect those performances to converge and to mirror each other. And it's why I said, nationally we expect 2.8% rent growth. Well, that's because we expect the Midwest to continue performing in line with how it is today, which is healthy, organic rent growth from strong demand and limited supply. In the Sun Belt, we expect those markets to converge on that national average because of the longer term outlook for stronger job growth, for stronger migration, for stronger population growth and household formation, and the demand that brings to multifamily. So in those later years of the forecast, those underperformers today across the Sun Belt are going to outperform those Midwest markets by a slight margin as they play catch up from what they.
Matt, just to put a fine point on that. Sorry to interrupt. One of the things that you've always said that I really love is, developers have built exactly where you would want them to build right now, where there's a lot of demands. And so, for example, I know you talked about kind of the difference between the Southeast and the Midwest, but the mountain states as well, right? I mean, and this is an area of the country that's one of the fastest growing parts of the country. I mean, several of the fastest growing economies in the country are in the mountain states, and they're not necessarily, and these are diverse economies as well. I think that's the other important thing to note. You can look at past histories of different boom towns and different things that might be relying on one thing or another. No, these everything from semiconductor and tech to finance and different things of that sort. And so I think you're spot on. These economies are going to continue growing at high rates. The supply has dropped back, but all of the tailwinds for demand remain in place, whether it's the differential between renting and owning, which you've done. You've really pioneered a lot of the research recently on that, and the sort of general shortage of single family housing, which is fueling demand in multifamily. So anyway, I just wanted to jump in with that.
Yeah, that's great.
And there is another question on senior homes. Half of the population hasn't saved for retirement. unless seniors is subsidized, how will this support solid rent growth? I can answer it from our experience. We build only free market, free rent properties, so we don't do kind of Medicaid, Medicare, or subsidized property. And we are experiencing a high rent growth. So those people, they usually own a home, and they have Social Security, and they can pay for the rent. They sell their home or whatever, and we don't see issues with that. But obviously, there is a part of that population that can't afford it, and will need to go to other facilities, more subsidized and based on insurance. But as you can see, actually, this diagram, this graph shows the demand as the growth of 75 plus cohort. So I think a percentage of those cannot afford free market senior living, but a big percentage of those can afford. And remember that the baby boomers are one of the most hefty and richest cohort in the United States. They made money over the years, and they can spend it on their last few years in a senior home.
I completely agree. And we're in the middle of some deeper dive research looking exactly at that. Finding the markets where we expect the strongest population growth, where there's the most limited supply, where the difference between the cost of those free market senior housing units and the cost of and the wealth of the individual. So we've got a wealth proxy that it also incorporates their home ownership, as you brought up. And lo and behold, of course, the Southeast and the mountain west states pop the most, because those folks have benefited the most from home appreciation, from their long careers in high growth markets, and the relatively lower cost, particularly in the Southeast, of those free market senior housing rents. And so we also believe, as you do, that those regions will have a sufficient demand side to absorb the little amount that is underway today being built, and that there's quite a lot of room for additional development.
Guys, we're getting to...
Yeah, Yuri, I wanted to ask you, how do we feel about timing? Should we just wrap up with a few comments?
Yeah, so we have another 5 minutes, I guess. There was a question.
Let's wrap up the...
Yeah, let's do retail. We have 2 more questions we'll ask, and we'll wrap it up.
Well, look, we don't have a lot to say about grocery anchored retail, other than it is a very high performing asset class, subclass of U.S. real estate. And not just any grocery anchored, but particularly high quality grocery anchored. The story in retail is today what it's been for really a number of years now, which is the economy continues to grow. Demand for goods and services continues to grow. And yet the supply of retail continues to shrink. The vacancy rate remains very, very low. And when there is a move out in a high quality retail center, it's viewed as an opportunity for the owner to be able to backfill that at a higher mark-to-market rent, as Yuri said earlier about some of the work that he's been doing with Boligo's investment strategy. And so we just sold a two property portfolio outside of Washington, D.C. in the Northern Virginia submarket, and I did a little research as we were launching and marketing this deal, and I found an academic study that concludes that high quality grocery anchored retail that is adjacent to or connected to multifamily, that the multifamily properties sell at a 47% premium per unit compared with non-high quality grocery anchored multifamily when you control for location, et cetera. And so, with an investment, when there's an opportunity to invest in both multifamily and adjacent or mixed use grocery anchored retail, it is a very strong winning recipe. That's
great insight. We've also experienced that, our shopping centers are at, all-time high occupancies, And that's because, as we see here in the diagram, they just didn't develop enough retail in the last decade. And it's definitely shown on occupancy, and that sector has proven itself through COVID and even in the recent recession of the last 2 years.
Yeah, I would just say to wrap up the comments on retail, it's turned the corner. I think a lot of people will remember very well the headlines of the 2010s about retail, and it's completely different now. And we see investor interest there, and the investor interest is there for a good reason, and it's shown in this chart. It's the extremely strong fundamentals that continue to strengthen in the retail sector right now.
Cool. Let's take a question. So in the area of senior housing, are you concerned about accelerating labor costs? And will that, yeah, go ahead.
Yes.
And
I
labor
mean,
shortages, yeah.
But what I will say is that those labor costs are more concerning as you move up the acuity spectrum. So as you get into memory care and skilled nursing, those heavily Medicaid reliant subsectors of senior housing rely on labor that is much more scarce. All right, and when you look at sort of the free market, sort of independent living, assisted living, and lower on the acuity spectrum, those labor constraints are not nearly as strong because many of those folks working in those properties are hired away from Walmart, right, and other places. And so the constraints, as we see it nationally, much less severe in sort of those free market type of units than it is.
We are doing assisted living, memory care, and independent living, and definitely a great question because it is a concern. We also had really a crisis with labor post-COVID because many service industry people left work and never came back. I feel that it's stabilizing, but another thing is that we see much higher rent increase compared to labor cost increase. So that kind of levels that out. Just as an anecdote, we are now starting the lease up on a newly developed a senior home that we've built, and obviously we modeled it probably 3-4 years ago. And our rents now, our street rents, our market rents, are $500 a month higher than what we modeled in our pro forma. So that's much more than the addition of labor cost, but it is a concern, and it's something to look at, definitely.
Yeah, I think, by the way, one more comment here is there's a regional and geographic comment that probably ought to be made here, and that is, you're right. It's not so much the labor cost that is a concern because of the imbalance of supply and demand and the strong rent growth that's outpacing that labor cost. It's the labor availability, and there is such much stronger labor availability across the Sun Belt, where those population growth and migration trends are benefiting the most. And so, I think there's greater concern in certain markets and regions around the labor availability.
There are some markets where household price, the house is so expensive and rent is so expensive that service industry people, those caregivers, cannot live there. They need to live. You need to draw from an hour or an hour and a half away, and that's definitely a problem.
That's right, and that's why that Sun Belt and particularly Southeast receives more favorable comments and outlook from us and other forecasters of senior housing like NICMAP and others. So, any other questions before we?
Two more quick questions, please.
Final questions.
Yeah, final two. So, when do you expect oversupply in the Mountain States to be absorbed?
For multifamily, we expect that to play out between now, really over the next, I'm going to call it 9 to 12 months. All right, that rent growth will resume a positive and accelerating trajectory in the first half of 2026. And then after that, very little new supply being added to the market in later 26 and 27 and beyond. So that's the timeline, really 9 to 12 months.
Okay, and the ultimate question, I never thought about asking it, but someone actually did. Let's see how you answer this one. Which real estate sector do you believe is most worth investing in over the next 2 years?
Look, I think it's a very good question, and I think there are going to be, and I don't mean to be cute with this answer, but there are going to be opportunities across sectors. We talked about some of the structural elements that are fueling demand for multifamily, but the reality is we've had pricing resets across the board. We have strong fundamentals largely across the board. And so, despite all of the uncertainty and the different headlines and different things of that sort, investing in 2025, you're going to see the highest returns of the cycle without question. And so, again, that due diligence is going to be really important, that NOI. But I think you're going to be able to find, opportunities across the spectrum. But personally, I love the story of retail. I love the story of multifamily. And then of course, office is back, a little bit more selective there, I would say. And then over the medium term, I think there are going to be some interesting opportunities for industrial, even with all of these changes to trade policy. So I'd say, multifamily retail kind of for me personally. But I think across the board, you're going to be able to find some really compelling opportunities, this year and in the coming quarters.
Well said.
Thank you very much, Darin, Matt,
Appreciate it.
Theo. We really appreciate you coming here today and speaking to us and our investors. It's been fascinating and great insights. Thank you very much. We'll see you again soon.
Pleasure. Thanks
Thank
for
you
having
for
us.
having us.
Enjoyed it.
Audience. Thank you all our investors and not our investors that joined us today and participated in this session. Thank you all and have a great day.